I've had a lot of questions since last week about market cycles, about where we're headed in single family housing. Stay tuned and I'll tell you where I think it's headed and when the right time is to buy and sell. Hey everybody, Greg Barron, Professor of Real Estate. Thanks for joining me once again today. You know, this economy is like painting a moving train. It's impossible to manage and it's so hard to keep up with. But today I'm going to talk to you about what the housing market is doing, because last week we visited the different asset classes and where they fit on this roller coaster of a market cycle. If you remember from last week, and if you haven't viewed it, go back and view last week's, because you're going to gain a lot of information of what I'm going to talk about today. So real estate follows four basic market cycles. You start with recovery, you move to the expansion phase, you tip over into hypersupply, and then finally into the recessionary phase, moving back again into recovery. So once again, we show that the asset class of office is clearly on the bottom side of recessionary. You know, it's full of concessions. It's all the way down to that recessionary cycle and it's hit bottom. Multifamily is just peaked over the equilibrium point about a quarter of the way down, where it's in the hypersupply stage. We've got product that started 2 years ago that's now coming online, where you've got rent concessions starting, we've got rent starting to abate and slowly lower. So it's the hypersupply. If you remember too, I also said hypersupply phase is the phase that you don't want to buy in, because simply you don't know how far it's going to drop into recessionary. The other asset classes are a little bit grouped around the top. We know that industrial has peaked over, but it's still fairly strong, and there's not a tremendous amount of new supply coming on the market. Self-storage is still pretty good. If you don't have a lot of fixed debt that was at 3%, is now getting ready to refinance in the latter quarters of 24 and the first quarter of 25. But it goes back to the question that I originally posed. Where is single family housing in that particular market cycle? And then we've got some really interesting dynamics to show you. But before we get into where I think it's headed, let me give you some major points to consider as we are going to try to figure out predictively where the housing market is headed the rest of 24 into 25 and 26. So let's hop into Performa Plus. It has a resource link which shows you several general economic indicators. So it goes without saying the interest rates have doubled since around August of 2021. And if we look at Performa Plus here, we can basically mirror what I'm saying. Back in January to March of 2021, you can see that prime rate was at 3.25. The Fed fund rate was 0.08, basically nothing. And SOFR was 0.04, which closely mirrors the Fed fund rate. Now fast forward through 11 rate hikes, and the Fed fund rate is still hovering around 5.33. The prime rate at a whopping 8.5 and SOFR at 5.32. So it's practically doubled. Now, as of today, I believe that long-term 30-year mortgage interest rates are right around 6 3/4, maybe a little bit more, and that's with a perfect score and no buy down. So the next thing I want to do is I want to look at new housing permits and also active listing count. A great market is when you have about 5 to 6 months of inventory on hand to meet the demand. Still presently, we have 4.1 months of inventory out there. So as you can tell by that index, we still don't have enough supply on hand to meet the required demand. Now, if you take another look at the new housing permits that I'm showing on the resource link, you'll actually see a little bit of fade in new housing permits. That's to be expected. Over here, you have the active listing count, which right now is showing about 884,000 units that are listed. You can see also this trend that's ticked up as expected. As interest rates have increased, there's been a lockdown of selling, there's been fewer buyers, so we can anticipate a more active listing count. Also, under housing inventory, if you follow this, it's continually increased because the demand is increased. We've got right at 1,466,000 houses out there as potential inventory. It's still at 4.1 months supply, not 5 or 6 months that's needed. So these are really interesting paradox numbers because on one hand, we've got a lockdown, we've got not enough sellers, and we don't have enough buyers, but still, where are we in this market cycle? Are we in the recessionary period? Are we in hypersupply? Are we in the expansion phase or are we in the recovery phase? So let's take a look. So we have a low supply, we have slower sales, we have a sluggish rate reduction, but we have high median prices. So what does that tell us? Where are we on the market cycle roller coaster right now? I would suggest to you that we're still about the top quarter of the expansionary quadrant. So the question would be, is it falling over this roller coaster ride going into hypersupply like the rest of the asset classes? And I would suggest to you that the answer is no. As a matter of fact, around February of 22, March of 22, we really hit our peak equilibrium. We had the maximum amount of sellers, we had buyers, we had peak prices, we had demand for the product. If you were out there trying to buy a house at that time, you could have 10 offers on a house and they could come in all over the asking price. There was a flurry of activity. People were getting prices they never thought they would get. So we've slipped back down. We're still in the expansion mode. And the question is, are we ever going to move over the top into hypersupply? I would say probably not for a while. So I've had a lot of people ask me, do you think there's going to be a crash in the housing market? I don't think so. Number one, the last crash we had was between 2008 and 2012. A crash really technically is a 30% reduction in the value of the property. I believe we might have a 5% correction, plus or minus, but 30% suggests that you're going to have a lot of foreclosures. Why won't we have foreclosures? Well, primarily because 80% of the market has got a rate below 5%. Of those 80%, they're pretty safe in what they have right now, and they've got a lot of trapped equity. So there's not going to be a lot of foreclosures. Additionally, those that are applying for the loan now, the typical credit score is right around 772. Why is that? Well, it's because banks haven't loaned to many creditors with anything less than that. So bank covenants have tightened. So anything that's been financed in the last few years has done so with some very strict loan covenants. So you've really got this wonky market right now. You would think that we would go into hypersupply like all of the recessionary periods before, but we're just not. The reason is because you still don't have the supply to meet the demand. On top of that, you have to layer in the affordability issue that's still staring everybody in the face. The new median house price is still hovering around $500,000. So the last thing I want to show you is a predictive tool where most economists think we're heading. Now, this is called a SOFR forward-looking curve. Now, think of SOFR as mirroring a Fed fund rate. So right here, where we are today, August 7th of 2024, you see SOFR is at 5.28. That's pretty much where the Fed fund rate is right now. So if we take a forward look of where most economists think we're going to land with the anticipated rate cuts in the future over the next 2 years, you can slide down this curve and you can see that even at May of 2025, they're predicting SOFR to be 3.58 or the Fed fund rate to be 3.58. Now, how does that correlate to, say, a 30-year mortgage? Now, add 150 to 200 basis points to this 3.58, and you'll come close to getting your 30-year mortgage rate. So you can see at May of 2025, they're predicting that rates long-term would be around 6%. They actually don't go too much lower, and even into January of 26, they're predicting 3.1%. Add 200 to that, and then maybe you get at 5 to 5.5%. So what does that mean? That means that you still got 80% of the buyers that are locked in below 5. The question is, are they going to sell for a compatible interest rate that they've had previously just to untrap some of the equity? I don't know. But what I can say in conclusion is I think that it's going to be very slow to rebound. We're not going to put a lot of product on the market because, frankly, you don't have a lot of people buying yet. Every time there's a rate cut, there's a little bit of euphoria that goes on. Maybe in September, it might be 25%, maybe 50%. Maybe in December, it'll be another 25%. There'll be a few people out there that get FOMO and want to refinance because they'll have a lot of brokers telling them, hey, you got to do it now. It might go back up. But realistically, the rates will start to step down over the next 2 years, but they're not going to step down to 0.8 where they were when this all started. You're still going to have a lot of people that are locked in below 5% that are unwilling to move for the same rate. So you're going to see a lot of headwinds. It's going to be balancing out over the next 2 years, but it's just going to take time. By the way, if you're enjoying this material, be sure and like and subscribe, and always leave me comments. We try to get to all of them that we can. So you ask me, is there any opportunity in what we're going to see over the next 2 years? I would say there's always opportunity where there's disruptions. You just have to be creative. Don't over-lever yourself. Be sure and stockpile some dry powder for opportunities. And also remember that 50% of the migratory movement, the new housing construction, are going in places like Texas, the Carolinas, Tennessee, and Florida. That should give you an indication of where that wealth will be built and where equity can start to increase the best. Now, if you live in Chicago or San Francisco, I'm sorry, it's going to be a little bit more difficult. But those are the 5 areas where you're going to see the most amount of equity accumulate faster, in my opinion. So as I always say, educate, evaluate, so that you can ultimately execute to increase your own personal wealth. Thanks for joining. We'll see you soon.